Today I want to address the chart you see before you. This is a chart of the Fed's balance sheet versus the S&P 500. Now I took the Fed's balance sheet and divided it by 2,000 just so that the lines were actually close to each other and we could see the correlation, because if the index for the S&P is denominated in much smaller units than the millions and millions of dollars of the Fed's balance sheet. So I'm not manipulating the scale of the chart so much, or excuse me, I am manipulating the scale, but I'm not manipulating the movements or the intensity of the movements. And so if anyone disagrees, leave a comment, but I think I'm being fair in how I'm presenting this data. Now, the reason why I'm presenting this is because this chart, at least on the surface, would counter the points that I was making yesterday about the source of the stock market bubble lying more with the repo market and with the treasury market, rather than quantitative easing and bank reserves. And so just as a review from yesterday, the basic idea, which I'm getting from a number of people, different thinkers, this is sort of a new idea that I've recently come upon, but mainly Jeff Snyder is the one who is doing the most work in this area and trying to educate people on what he believes to be the correct position. The idea is that U.S. Treasuries are serving as sort of a monetary base in the repo market, which is being levered up to 30 times in order to fund asset purchases. And that's very different from the traditional theory that I and many other people, at least most of us who are concerned about the asset price bubble, the main theory that people in this space have had for the entirety of the last decade was that the Fed's quantitative easing was pumping money into the financial system, and that was bidding up asset prices. And this chart was always our exhibit A. And unfortunately, I'm using data from the Fed, and their chart of the S&P only goes back to 2011. But I assure you, if you go all the way back to 2009, this relationship, this statistical relationship, this correlation is still there. But as we can see, the market kind of moved up, but not incredibly high, while the Fed's balance sheet, the red line, was flat. And then as the Fed started to taper off and to conduct quantitative tightening, we see that there got to be a lot of volatility in the stock market. This was 2018. Fall of 2018 is when this really started, and then we got the Christmas Eve massacre, and eventually, I can't remember the exact timetable, but this was while the Fed was cutting rates. The Fed then said, okay, this was while the Fed was raising rates. The Fed then said, we're not raising rates. And they continued to let the balance sheet run off until the repocalypse of September 2019, in which the Fed transitioned into not QE, which was, essentially QE4. And then in March of 2020, when markets took a nosedive, from there to the present, it's almost a perfect correlation between the growth in the Fed's balance sheet and the growth in the stock market. And so it's very easy to look at this and to go, well, gee, isn't it obvious? The Fed growing its balance sheet is directly pushing up the stock market. And this is what I've always thought. But I'm taking a step back today to try and consider the alternative, because I've never found a true logical correlation between the two. I've never figured out the transmission mechanism from how bank reserves get turned into dollars that are spent on buying stocks. I had never found any reason directly why stocks were going up and where all this money was coming from that was pouring into the stock market until I discovered Jeff and the repo market. The repo market is, clearly shows how money is created and then spent into the stock market or other risk asset markets. And so with that said, now all of a sudden I have the first potential explanation for how money is created and spent into the stock market, how the stock market prices are inflated artificially, and how multiple expansion continues year after year. All of a sudden I have that explanation. But that explanation has nothing to do with the Fed's balance sheet. And so it almost leads me to believe that this is, if not a specious correlation, something along the lines of the Phillips curve, which of course is one of the most pernicious cases of correlation, or of correlation not equaling causation. And from what I understand, people at the Fed still unfortunately use the Phillips curve. But for those of you who don't know, the Phillips curve is a statistical relationship between inflation and unemployment. What this guy Phillips said is that he said, hey, gee, when inflation's high, unemployment is low. And when inflation's low, unemployment, is high or it goes up. They move in opposite directions, is what he was trying to point out. And so this led central bankers and, old school hydraulic Keynesians to come to the conclusion, well, gee, the answer to low unemployment or to high unemployment is inflation. We need to create more inflation, then unemployment will go down. And if and therefore, if inflation gets too high, well, then people need to lose their jobs. There's too many people working. The economy is just being too productive. And so that's what's creating all this inflation. It's all these people who have jobs. And so we need less people to have jobs. That was sort of the idea of the Phillips curve. And of course, this is ridiculous because the correlation between these two variables, it was not these two variables acting upon each other. They were both results. They were both products of credit expansion. When you expanded credit, you extended credit to businesses so that they could expand their business, hire new people, therefore unemployment goes down. But also, through the expansion of credit, you're creating new money, you're injecting new money into the real economy, and that creates inflation. And so therefore, the Phillips curve was ridiculous and did not make sense, which is why eventually it broke down and, isn't used by a whole lot of people, at least not in the way that it used to be. But perhaps this chart that we all like to use so much, showing the correlation between the Fed's balance sheet and the S&P 500, perhaps this is a similar situation to the Phillips curve. And I just don't quite understand yet what is causing this correlation. Because like I said, I can't find a causal link between the expansion of the Fed's balance sheet, the injection of bank reserves into the commercial banking system, and the price of stocks going up. What I have found is a logical causal link between the expansion of credit in the repo market and the rise of stock prices. But if anything, the expansion of the Fed's balance sheet actually has a deflationary effect on the repo market because the Fed is pulling treasury bonds out of the repo market that could be used as collateral. So I think this is kind of where I've hit a wall on this week-long journey of trying to explore these new revelations I'm having regarding monetary theory, well, applied monetary theory. I mean, there's nothing fundamentally that's changing to me about my understanding of money. It's just the application of it, of monetary theory in the present day. My understanding of the monetary system has changed. But it has not progressed far enough for me to be able to square this circle. Back when I thought that there was no other explanation for the rise in asset prices other than the expansion of the Fed's balance sheet, even if I didn't fully understand what the causal link was, I thought, well, there must be some causal link that I'm just not seeing. It was very easy for me to believe that because there was no other potential candidate that was causing the inflation of asset prices. And so my best guess at this point is that QE is at the very least an expectations game, and that by conducting QE or QT, the Fed is sending signals to the market writ large. But even with that said, that doesn't make a whole lot of sense if you assume that the big players who are driving these upward movements in prices are the players in the bond market and the repo market. If anything, I would think if I were in their position, if I saw that the Fed was going to do QE and pull collateral out of the system, I would turn bearish, if anything. It wouldn't make me double down and lever up even more, although that appears that's the correlation we're seeing. That is what the data is showing us, is that when the Fed conducts QE, we see a huge multiple expansion. We don't see economic growth, remember. We're seeing multiple expansion. The price-to-earnings ratio is rising. That's what we witness. Now, one last thing, and I think this will be my last point. Where this does differ from the Phillips curve is that, like I said, inflation and unemployment were both symptoms of something greater. They were both the result of something else. Quantitative easing is there's nothing greater than that. It's done at the Fed's discretion. It's not a side effect of anything. QE is 100% discretionary. QE is as big or as small as the Fed wants it to be. And that is why I think it's been so easy, again, for so many of us to assume that this correlation is a direct causation, because there's nothing else that's causing QE to rise other than just what the Fed does. And so why else would QE strongly correlate with any other variable? Because remember, QE is a product of nothing but Fed discretion. And so if QE has a strong correlation with any other economic variable, the obvious conclusion is that QE is that other variable is a product of QE. And that therefore, that variable, in this case the S&P 500, is the product of the Fed's discretion. And so here I am very split. The data still suggests, and again logically here, it still suggests that QE is having some impact on stock prices, but I just don't see how mechanically. Mechanically, the repo market explanation is what makes the most sense. And as far as I know, the Fed's balance sheet expansion does not have a positive impact on credit expansion in the repo market. Like I said, if anything, it has a deflationary effect on the repo market. And so obviously, I still have very incomplete information. Either I'm getting something wrong, or there's still more concepts that I completely am ignorant of. So that's as far as I can take this analysis for today. If I think of anything more, I kind of want to take a break from finance because I feel like I'm doing an overload of it this week. But if I think of anything more, I will address it. I will keep continuing to develop these ideas and to figure out what the hell is going on. Because until I figure out what is going on now that I have these doubts in my mind, I can't be sure about the future. If you don't understand the present, how are you supposed to understand the future? So with that said, I'll see you folks back here tomorrow.